All right, so I'm going to introduce chapter 4 today. Chapter 4 has a few different parts. We're going to be focusing in on um, some very important knowledge of accounting principles in Learning Objective 1. And then we will do the rest of the bookkeeping cycle in this course as well. So chapter 3 starts the bookkeeping cycle. Chapter 4 finishes it. All right. But to understand these concepts are really important. We have what you're learning is something called the accrual basis of accounting. It's just simply how corporations, public corporations, are required to do their accounting and keep their system. They have to recognize things in sort of real time in the period of time that they happened. And so whether or not they collected any money or not is not the issue. They have to just document events in their accounting records that impacted them. And that's basically what you're learning throughout the whole class. It's called the accrual basis of accounting. There is another way to do accounting. It's called a cash basis. We don't deal with that in this class, but it's a legitimate basis of accounting that a lot of small businesses use. They basically do accounting based on the movement of cash. When they get cash, they mark it down in their journal. When they use cash, they mark it down in their journals. They don't do any other accounting other than when cash is moving. Corporations cannot do that. Corporations cannot do that. They have to follow the accrual basis that's required by GAAP. And so think about when you keep records for a business. Remember, we have to divide the economic life into artificial time periods. And we use basically 3 time periods. We measure things by the month. We measure things by a 3-month period. We call that a quarter. And we measure things for a year. Notice the shortest period of time that we measure is 1 month. And the longest period of time we measure is 1 year. Now, what exactly do we measure every month, every quarter, every year? Well, we measure our profit and loss. In other words, we create income statements, which means looking at revenue and expenses on a monthly basis, again on a quarterly basis, and on a yearly basis. We do not measure profit and loss longer than 1 year. We do not measure profit and loss shorter than 1 month. Okay, so this is really the periodicity assumption. When we divide the life of a business into time periods, these are the time periods we're working with. The shortest time period we measure is 1 month. The longest time period we measure is 1 year. Well, businesses are not going to just be in business for 1 year, right? They're going to be in business for many, many years. You think about some of the very older businesses that we do have. So, for example, Procter and Gamble, which makes lots and lots of your basic household things from soaps and shampoos and dishwashing and laundry detergents and products that you and I use for personal care. They've been in business for well over 120 years. So what does that mean? Well, they've had to measure their income statement for 120 years. Okay. But they had to do it in no longer than yearly periods of time. Okay. And so this is really what we're talking about. Businesses have to record things. Specifically on the income statement, we're recording revenue and expenses, yes? And so we are measuring our profits monthly, quarterly, and annually, but we have to keep the records separate. So let's say we use a calendar year, which is basically January the 1st through December 31st. So for every month in that year, we would have an income statement. And then, of course, a 3-month period, we could show the quarterly income statement and profit and loss for the quarter. So we can compare quarters. This is what happens on Wall Street all the time. They look for quarterly earnings. That's what they're talking about. But the longest period of time we're going to measure is a year. Well, what happens after December 31st of that calendar year? Well, it's going to be January 1st of a new year. Well, guess what? We have to keep separate records. The periodicity assumption means that we have to keep a separate yearly record, okay? And those have to be separate year to year to year. So Procter and Gamble that I mentioned before, that corporation, they have over 120 separate records, right, for showing each year that they have been in business. Apple has been in business for over 40 years. They have 40 separate records. Now, what do I mean by record is they have 40 separate income statements. The record that we're most interested in as owners is whether we made a profit and loss for a year. Okay. We're looking at it monthly, quarterly, and certainly annually. But we have to basically keep these records separate. So what happens the very following day? So again, if we're looking at a calendar year, January 1st to December 31st, the very next day is January 1st of a new year, what happens? Well, what happens if we have to basically start all over again. We have to start counting our revenues again from zero. We have to start counting our expenses again from zero. Why revenues and expenses? Because that's what's on the income statement. Okay. So this entire chapter is going to be talking to us about this process. We call this process basically closing the books. Every year we need to close the books on one year in order to open the books, start from zero, for a new year. That only happens with revenue and expense accounts. And the income statement is the very first statement that's done. Matter of fact, if you look at an income statement at the title of the income statement, it'll say income statement, well, they'll say the name of the company, income statement, and then it'll mention the period of time for the month of, or for the year of, or year ending. That tells you it's based on the periodicity assumption because it measures a period of time. Right. The same is true for retained earnings statement, but of course everything starts with the income statement, so that's really where the emphasis is here. The retained earnings statement also measures the exact same period of time as the income statement. But again, the important thing is to focus on the income statement. Revenue and expenses are really the focus here. Well, again, every single year has to be separate. Do they have to use the calendar year? Do all businesses have to measure their year, January the 1st to December 31st? No, they have a choice. They can also use something called a fiscal year. And a fiscal year is a 12-month period of time. Any 12 months, as long as they're consecutive. Okay, can't skip over months because you don't like the month. So why would a business use a fiscal year rather than a calendar year? Well, it sort of depends on their business. And when they actually want to report out the profit and loss for that year. So the question really, when is the year end for some businesses? Well, if you're a dental firm, you're a hospital, you're going to basically, you can use the calendar year because you don't have any really big things happening through the year. It's not like you have a very, very big season. But that's not true for retail, for example. Retail has one huge season called Christmas. And the Christmas shopping season starts usually in October and it runs all the way through January, because there are a lot of after Christmas sales that are quite big. And things usually are happening all the way into January. Usually by mid to the end of January, the mall is pretty dead. Okay, everything's basically ended. So does it make sense for a retail company to use a calendar year and report their profit and loss on December 31st? No, it doesn't, because their big season there is still going on. Where they make most of their money is the Christmas season. And so they're not going to stop on December 31st and say, okay, let's report our profit and loss this year. They're going to let the season play out, and then they're going to report. So they're going to use a fiscal year. What's a fiscal year look like for a retailer? Well, any 12-month period. It could be February the 1st all the way through the following January 31st. Again, it's 12 consecutive months. That's a fiscal year. Do they have to use the firsts? No. They can decide that January the 21st of this year through January 20th of the following year is their fiscal year. It's going to be a 12-month period of time, but it can be any 12 months at a starting point. 12 months later, it ends. And that's their period that they're measuring. Again, what are they measuring? Profit and loss. All right. Again, they have to separate these every year, whether they use a calendar year or a fiscal year. So the process that they have to go through is they have to adjust their books first before they can close their books for the year. And that's what makes Chapter 4 really challenging. That whole process is explained here. Okay. So again, the important parts here: periodicity assumption, artificial time periods, month, quarter, year. Companies can use either a calendar year, January 1st to December 31st, or they can create their own fiscal year, a 12-month period of time that they can start and end as long as it's 12 consecutive months. Doesn't matter. So why do they do that? Well, they have to follow generally accepted accounting principles. Periodicity assumption is one of those assumptions that GAAP is based on. But here's a very important generally accepted accounting principle called the revenue recognition principle. And it means that we have to recognize the revenue. Remember what revenue is, right? It's when we sell something or do work for someone. We have to recognize that revenue on our books when we have performed it. Okay. So as soon as we do the work or as soon as we deliver the goods, we have to record revenue, regardless whether we've collected the cash or not. Okay. And so whenever we do the service is when the revenue is recognized, not when we receive the cash. That's the difference between this method called the accrual-based method and the cash method, the cash basis of accounting. In the accrual method that you're learning, we have to recognize revenue when we do the work. In the cash basis of accounting, which a lot of small businesses use, they actually don't recognize the revenue until they get the cash. Then they put it in their books. Corporations cannot do that. Okay, we have to recognize the revenue at the time we do it, not when we get paid for it. Okay. So here's an example of that. You have a dry cleaner, and they clean clothes on June the 30th. Now, June is a month, so that's the period of time we're working with, is recognizing all of our revenue for June, right? This work was done on June 30th, so the revenue has to be recognized on June 30th, even though the customers don't show up for a week later to pay. So if you're following the revenue recognition principle, you did the work on June the 30th, and so you have to recognize the revenue on June the 30th, which is what they did here. You set up a receivable to show you haven't received the cash yet, but you are going to credit your service revenue on June 30th because that's the day you did the work. That's what's required on the revenue recognition principle. Then a week or so later, when they come and pick up their clothes, they give you the cash. We accept the cash and pay off, or basically take away their accounts receivable, right? Because we're no longer waiting to receive the cash. When we debit accounts receivable, it's because we're waiting to receive cash. Why? Because we did work. When we credit accounts receivable, we've received the cash for that work. Okay, that's it. That's really how that account works in general. Well, if there's a revenue recognition principle, there's got to be an expense recognition principle. I mean, let's be fair. And basically, this means that we also have to recognize expenses in the period of time that they happened and not when we pay them. Okay. So in essence, we are matching the expenses with the revenue in the period of time that we earned that revenue. And actually, if you get the revenue recognition stuff, this is the same. So look how much GAAP you're learning already. Woo! Right? Very important to know that accounting is based on a periodicity assumption in which we are dividing the life into artificial time periods. That's a month. The shortest time period is 1 month. The longest time period is 1 year. Okay. That's critically important to understand. And because the periodicity assumption affects periods of time, the income statement obviously falls under this assumption because the income statement measures a period of time, a month, a quarter, or a year. So that income statement has revenue and expenses on it. And so thus we need to make sure we are recognizing all the revenue in the right time period. And we are also recognizing and matching up the expenses in the same time period that we earn that revenue. And basically, this is what GAAP requires of public corporations. It's not required of other businesses, small or medium or even large, as long as they're not a public corporation. They're not affected by GAAP. Okay. So again, what you're learning is something called the accrual basis for accounting, in which we are actually recognizing revenue when we do the work, and we are recognizing expenses when they actually happened, even if we haven't paid for the expense yet. That's the opposite of the cash basis. The cash basis only follows the cash. The cash basis of accounting, and a lot of small businesses do this, they will record their revenue in the journal when they get paid for doing their work. They will recognize the expenses in the journal when they actually pay for the expense. Okay. So in essence, there's no matching. There's no matching. So even if you made, say you're that dry cleaner and you did work on June 30th, but you didn't get paid until July, under the cash basis, you're not even going to list that you made it, that you did any work on the 30th. You're not going to list it until you get paid in July. So corporations cannot do that. Public corporations cannot do that because it does not apply. It doesn't match things up well. It doesn't actually give you a more accurate picture of what happened. And again, the cash basis can be used, but just not by public corporations because they're subject to GAAP and other businesses are not. Okay. And you are learning the rules. So here's an example of what I was just talking about. Here you have a company called Fresh Colors, and they paint a building in 2016. Okay. That building is painted for $80,000, and they spent $50,000 of expenses for that building. Well, they painted the building in 2016. Under the accrual method, everything happened in 2016 because the building was painted, and so we had to incur expenses to paint that building. So we earned the revenue in 2016 and we incurred expenses in 2016, and thus we had a profit of $30,000. For the cash basis, they don't record anything until they pay the cash. Well, when did they pay the cash? They paid the expenses in 2016. So they record the expenses in 2016, but they didn't record any revenue. Why? Because the customer didn't pay them until 2017. So that's when they're recording the revenue. So again, under GAAP, corporations cannot use the cash basis. However, small other businesses can. Okay, so at the end of a year, at the end of a period of time, literally, every time they prepare an income statement, they have to do something called, they have to do some adjusting entries. And that basically is sort of a double checking process to make sure that all the revenue is there and all the expenses are there before they actually prepare the financial statement. Why is that important? Because the very first financial statement is the income statement. Okay. So when you're preparing an income statement, you have to make sure, whether it's for a month or for the year, all the revenue you earned in that period is there. All the expenses you had in that period are there. And sometimes you just simply have to um, double check, right? To make sure those numbers are good. That's what the adjusting process is about. That's what these adjusting entries are about. We're going to be doing this in the next class. Okay. What type of adjusting entries are there? Well, learning objective 2, which is going to be part of our next class, is going to introduce you to adjusting entries for what we call deferrals. Deferrals are basically assets that turn into expenses when we use them, and liabilities that turn into revenues when we earn them. So learning objective 2 is going to focus on that. Learning objective 3 is going to focus on the adjusting entries we called accruals. And accruals simply mean we want to make sure we have the revenue on the books, even though we haven't collected it yet. And we have to make sure the expenses are on the books, even though we haven't paid them yet. And so you're going to be learning that next time. Okay. Now, again, anytime you do an adjusting entry, you're doing them in the entries go into the journal. This is where chapter 3 comes back, right? Everything you put into the journal, right, travels to the ledger, which means that some accounts are going to have changes in their balances after the adjusting process is done. And that's going to be the focus of learning objective 4. And that's our introduction to objective 1 here. Okay, mostly definitions and understanding what we're going to be doing in the next in this chapter. So here we have a list of concepts on the left and the descriptions on the right, and we're supposed to match them up. So the accrual basis of accounting basically is when they record the transactions in the period they happened. Whether we collected cash or not, whether we paid cash or not, we're keeping track of it. That's accrual basis. Okay. A calendar year is the traditional year. Starts January 1st, ends December 31st. Instead of a calendar year, a company can also use a fiscal year, which is any 12-month period, at least if the months are consecutive, right? Periods. Periodicity assumption, as we know, that dividing of the business into time periods. What are the time periods? The shortest time period is a month. The longest time period is a year. After that year is done, we have to go through a process of closing the books to keep records separate year to year to year. The expense recognition principle, very much like the revenue recognition principle, right? We have to make sure all the expenses are recorded in the time period they happened when we earn the revenue, and thus concepts. That's learning objective 1 in chapter 4, introduction. Questions on that?